And we want to again thank you for being on this call today with Paul Sullivan, CPA, IAR, and principal of Sullivan Company based in Bethesda, Maryland. Our topic of the call today is what kind of pension plan should you have as a business, as an employee, or as a retiree? If you're not a current client of Sullivan Company or you've not met him, Paul Sullivan is a CPA and investment advisor representative, and for the past 34 years, Paul has provided business accounting, personal tax preparation, personal financial planning, and counseling services to clients everywhere. Mr. Sullivan has extensive experience in tax and financial planning for family-owned businesses, business purchase and sales, fringe benefits, pension plan selection, and installation in corporate and personal tax saving strategies. He has worked with businesses in virtually all industries, including construction, government contractors, retail, wholesale, and manufacturing. Paul has also worked with individuals in the areas of income tax preparation and planning and retirement planning, IRS representation, estate planning, and litigation support services. Paul is a member of the American Institute of Certified Public Accountants, the Maryland Society of Certified Public Accountants, and the Estate Planning Council of Suburban Maryland, Inc. And he also holds an insurance license and a Series 63 securities license. Paul, welcome to the call.
Thanks, Jeff, for the introduction. I have with me on the call Raj Goenka, CPA, works in our office, Chris Bailey, who is IAR in our office, and Ben Perrin, who's the same. Today is an educational call. We're trying to give clients this topic. We talk to them all the time one-on-one, and we actually record the call. We're going to use it for education purposes for our clients. That way they can tell the differences without actually speaking to us, and we can give them a lot of information. It's not meant to be a sales call. It's meant to give you education. One of the benefits of us is on this topic of retirement, since we've been in business over 30 years, we've seen how people do it right, and we've seen how people do it wrong. And that's what we're trying to tell you some things on this call is some people we've been through the cycle with, and they end up with Social Security. And some people we've been through the cycle with, and they end up with a good retirement, comfortable retirement for them and their spouses. The area we're covering is qualified plans. Qualified plans, the benefit of them is they give you a tax deduction when you contribute, and the principal grows tax-free until you take it out. So when we have someone put an IRA in a bank account and deduct it, they actually save $1,700 in tax. In addition, we have clients who have 401ks, and the employee contributes $18,000, and they actually save $6,000 during the year. This money is invested in bonds and stocks, and in most cases serves to be a baseline for all of their retirement planning. They might have other investments, and they might have other things they're doing to prepare for retirement. But at least with this baseline, they're getting a tax deduction, and it's accruing over time. Other clients we've had might do things such as income-producing real estate. They might invest in their own business, hoping to sell it, and they might do other things. But many of those tend to be more riskier. They can have a bigger return, but they also can be less certain on providing for retirement. In a qualified plan, invested in conservative mix of companies and bonds, it generally, we've seen people grow very large accounts. If we had to give advice to people on how they would not end up with just Social Security, we tell them start early and invest monthly. Begin as early as you can and put an amount each month. The reason we say that is that sometimes clients contribute to an IRA and they wait all the way to the end of the year and they put $5,500 or $6,500 in a IRA account, and they didn't get the benefit of it being during the year, and they have to do it all at once and sometimes defer it because they don't have the $6,500. If they contribute a little less than $500 each month, it comes into their regular monthly budget, and it's much easier to contribute $450 a month than to contribute $5,500 at the end of the year. So the contributing monthly is probably a chief characteristic of what we say are the winners. And even if they didn't do an amount that was sizable, they could do at least, most people can do between $0 and $300 a month. And $300 a month at 6% over 30 years accrues to $300,000. That $300 a month over 30 years is approximately $100,000 over 30 years, and at 6% it grows to $300,000. If you increase the yield, whatever you want to do, it can grow to $450,000 or $700,000 at 10%. But this tax-free growth is really a baseline for a modest payment that stays in their retirement plan, and they don't end up using it for other things because it's set aside. And these are the people that we see when they retire. They're not asking me questions like, should I draw Social Security at 62, because they don't have enough to retire. And we've seen people with successful habits, and we've seen people with habits that did not work. For example, if somebody had their own business, they invested in their own business, and at the end they may or may not sell their business for what they think it might be, and so their retirement wouldn't be as safe as it would be in a diversified, qualified plan. The first pension plan many times that we see a business adopt is a simple IRA, and the term is pretty well set because it is simple. And I'm going to introduce Ben Perron to talk about the characteristics of a simple IRA. And after he speaks, there's a question period after each one of these speakers, so you can chime up while we're on the topic, and then we'll move to the next topic. Ben?
Okay, like Paul said before, we move to the next topic. We'll give a minute for questions. So I'll hit some highlights of a simple IRA plan. Again, a great plan for companies with no retirement plan who are looking to start a retirement plan. A simple plan is a retirement plan designed very specifically for small businesses. Technically, it is for those with 100 or fewer employees, so small businesses certainly fall under that. It allows employees and employers to contribute money to employee retirement accounts. Now, the plans, simple plans, are easy, inexpensive to start up and operate. There is no cost to the employer to set these up. Each employee has the option of contributing to the plan or not. A participating employee decides how much of each paycheck to put in. The employee can put up to $12,500 into the plan each year, or if you're 50 years of age or older, you can put $15,500. On the other side, the company matches 3% of each participating employee's W-2. So, for example, Steve is 40. He makes $40,000 a year. He puts in 3% of his W-2, or $1,200, into the plan each year. The company, on the other side, matches 3% of his W-2. That puts him at another $1,200, $2,400 total saved for retirement. Now, to participate, employees must have been employed for at least 2 prior calendar years. To those who would want to put and are able to put more than $12,500, we would recommend a different plan, a 401k, for example. That is a potential drawback for those individuals. The limit on a 401k is $18,000 for an individual to put in, while it is only $12,500 for a simple. And if you're 50 years of age, those go up to $24,000 under the 401k or $15,500 under this simple plan. But the advantages are many. There is no cost to the employer to start up and to operate a simple plan. No administrative fees are paid to any administrator like with a 401k. There's also no annual filing report due to the IRS. Simple plans are a great way. We recommend them to help retain current employees and to draw prospective employees to your company. And again, employees are able to set money aside for retirement and save for the future. Their contributions are tax-free, saving money on taxes. And on the other side, the company match is also a deduction and saves the company on their tax burden. Now, before we move on to the 401k plan, I'll just open it up to any questions You can also wait and save all your questions for the end of the call.
Thanks, Ben. The lines are open, so if you have a question, just go ahead and speak up, and I'll check on the Internet to see what questions we have coming through there, if any.
Can we see the questions on the Internet?
No, but I'll read them to you
okay.
as they come through. Any questions for Ben on simple IRAs? And Ben, I don't see anything on the Internet.
Sure. If not, we can go ahead and hand it over to Chris. He can talk about 401ks, and maybe people at the end will come back with something on the simple IRA plan.
Sure, you bet.
Okay, Chris.
All right, thanks, Ben. My name is Chris. I'm an investment advisor representative with Sullivan Company. I'm going to talk about a 401k plan today. All right, a 401k plan is a plan you hear about a lot on the news and on TV. A lot of big companies have 401k plans, and a lot of small ones do too. So I'm going to go over the advantages and disadvantages of starting a 401k plan for your business. So the structure of a 401k plan is very similar to the structure of a simple plan. Again, money will be contributed from the plan from both the employee's paycheck and the employer's contribution match. Okay, so let me do a quick example. Let's say I work for a company and I make an even amount, say $1,000 a paycheck. And say I want to put in $50, I'm going to take $50 of my pay and put it into a 401k plan. So I'm going to put $50 in the 401k plan, that's about 5% of the 1,000. And then the employer is going to match on top of that 4%. So that'll be $40 that the employer is going to match, giving me a total of $90, my 50 plus his 40, into my 401k plan each check. So if you remember, that number of the match is a little higher than the number for the simple plan. It's 4% for 401k versus a 3% for the simple plan. And there are some exceptions to the 4% match, but in general, there's a safe harbor number, which is 4% for a 401k plan. So again, just to review, if I make $1,000, if I want to put in $50 a check, I put in $50. My employer would match on top of that $40, so I'd get $90 for my contribution. The amount that comes out of my paycheck is a tax deduction for me. So instead of being taxed on the $1,000 paycheck, I'm only taxed on the $950 paycheck at both the federal and state levels. That's, again, another advantage for both the employees and the owners to set up a 401k plan, is everyone gets a nice tax deduction to begin with. All right, and the main difference in a 401k plan and the simple plan is the amounts, the match, that's one difference, and then also the amounts that you can put in for the year. So all of your salary deductions total that you put into the 401k plan can equal $18,000 if you're under the age of 50 for the year, or $24,000 if you're over the age of 50 for the year, and that's before the match. So I can take out of my paycheck, if I'm under 50, $18,000 total with all my contributions for the year, and if I'm over 50, I can put into my 401k plan $24,000. All right, so that leads us into the main advantages of a 401k plan. The biggest advantage is that the employees get to save the most for their retirement and the most money on their federal and state taxes while paying the least amount of Social Security taxes. Social Security taxes are the 6.2% and 1.45%. That's called FICA, or Social Security taxes, that come out of everyone's paycheck in America every single week. And we're going to talk about some plans a little later where you can contribute quite a bit of money into a retirement plan. However, you're going to pay more Social Security taxes than if you would just have a 401k plan. And the reason why is because you can contribute that either $18,000 or $24,000 without raising your W-2 too high and paying as much FICA and Social Security taxes. All right, so that's, again, the main benefit is you get to save the most and pay the least taxes. All right, and it also provides a good benefit for employees. You know, quite frankly, it's 2015 and companies have 401k plans. All right, it's not the 70s, not the 80s or before, when people used to work for one company their whole lives. They get a nice pension check every week once they retire until they die. They get what's called a defined benefit plan. You know, those just simply don't exist anymore because it's too costly for the employees or the employers, and employees kind of move around to job. So what people want to do nowadays is save for their own retirement. They need to, and they do. And quite frankly, employees have just came to expect it, you know, especially if you're in a field where you make a lot of money, and even if you aren't, but if you're in one of those higher paying fields, you know, a lot of the employees just kind of expect their employers to have it, or else they're going to go somewhere else, or they're going to be asking for it. We had a case where we had a law firm in business quite a while, and he decided to get employees a couple years ago. He had this very ancient called profit sharing plan, and there was an employee, and another attorney was kind of asking, when are we ever going to get a 401k plan? And he finally did, and now, not only just him, but all 4 of the employees participate. And that's kind of what we see a lot, is that, a lot of people want them. Not everyone's going to participate. You're always going to get your people that don't. But in this day and age, if I'm applying for a job, I got 2 jobs that are exactly the same. One offers a 401k plan and one doesn't, and I'm serious about saving for my retirement and protecting my family until I die, then I'm definitely going to pick the one with the 401k plan compared to the one without the 401k plan. So again, it's just kind of the state of the times is that people really want 401k plans, and that a lot of businesses are switching over to them. And you probably believe your competition probably does. So if you don't have it, you definitely should talk about starting something up soon. Also, advantages is required to provide at least 3 investment options. You have to at least have a conservative, a middle ground, and an aggressive. And usually most 401k plans we see provide many more investment options than that for their employees that want to grow their money in different ways. Another advantage is there's a profit-sharing option for 401k plans, which is in addition to the employee contribution, the employer match, there's a profit-sharing option. And it works for some businesses, doesn't work for others. If you have an owner that really wants to save a lot, you can actually put in a total of $53,000 when you add the employee contribution, employer contribution, and profit sharing. Someone can put in $53,000, save on their taxes, and save for retirement in a year. However, there are some disadvantages to that. It's best to talk about this one-on-one if you'd like in your current situation. If you're interested, you can talk to me or Paul after this is over, and we can discuss if profit sharing is right for you in your 401k plan. All right, so that brings us to some of the disadvantages of a 401k plan. One disadvantage, at least a lot of employers think there is to a 401k plan, is all eligible employees must be allowed to participate. And in order to participate, as long as you've worked for a company 1 year, are age 21, and have worked 1,000 hours, you are eligible to participate. But one way to look at this is really, if you have a big company with 100 or 200, 1,000, 2,000 employees, your employees are going to want someone's going to want a 401k plan. You're going to have people asking you for it, so really, you really don't have much of a choice there. If you have a smaller company, which a lot of our clients are, let's say you have, a modest payroll, of 100,000. Say you have 2 people that make $50,000 a year. All right, so the most it's going to actually cost an employer is the 4% match. All right, so say it's 100,000, the match on that is 4,000. That's about $333 a month. So for $100,000 payroll, that's the most it's going to cost you is $333 a month, and that's really not a lot compared to how much you're going to save on your own taxes by doing the 401k. And also, a lot of times we see people don't participate. A lot of employees don't participate, and usually we see about half and half. Again, I gave you the example of the attorney where all 4 of their employees participated, but we just set up a company maybe about 2 months ago, and only the owner participated. Therefore, there was no cost to that owner at all. He had, I think, 3 or 4 other employees, and they all decided to just not participate, so there's actually no cost for him on his employees. There is a bit of setup paperwork for the 401k, which, we handle that for 401ks that we manage. But it does require maybe 2 or 3 meetings, and it takes a couple months to get this all going. There's just things we need to file and things we need to get signed. It wouldn't take more than an hour or an hour and a half of an owner's time to set one up. But there is some administrative paperwork in the beginning. Once it gets going, there's very little paperwork to do. And it's also a bit more costly than the simple, as Ben was saying. The simple has no administrative cost, but for a 401k, you're always going to get administrative costs because there are a lot of things that they need to get filed to the IRS, which is a normal thing for 401k. But, we've seen some of our clients get some 401k plans that cost up to $8,000 per year for the administrative cost. The one we would recommend for a small business would only cost about $1,500 a year, which is about as low cost as you can get for 401k. But again, when you add up the amount of money somebody can save, let's say they're 50 and let's say they do the full $24,000. plus say, I don't know, $3,000 match. So they can save, $25,000, $30,000, and typically, people save about 33%. So on $30,000, they would save about $10,000 on their taxes right away. Plus, they get to save for retirement, and as Paul was saying, the money grows tax-free each year. Usually, the benefits outweigh the cost for 401ks, and again, as I was saying, it's kind of the state of the times. Employees really want the 401ks, and are probably going to start asking for them soon if they are not already. So again, that's a little bit about the 401ks. Again, very similar to the simple plan, but a little more match, and you can put a little more money in. That's about all I have to say. I guess we'll open it up to questions now on 401ks. Anyone?
Thanks, Chris. The lines are open, so if you do have a 401k question, just go ahead and ask it, and I'll double-check on the Internet, see if you've got any questions.
Yeah, I have a question. When is the last date a company can establish a simple or 401k plan?
All right. The deadline for IRS for 2015 is October 1st. However, as I was saying, for 401ks, it takes about 2 or 3 months to get it started because of the paperwork. We recommend starting June 30th or early July at the latest if you're interested in 2015. But again, the absolute deadline is October 1. We suggest getting it started by June 30.
The biggest consideration we see is that if they adopt a plan in March, they're going to have monthly contributions from March through December. If they wait until August, September, they're going to have monthly contributions through 3 or 4 months, which probably is the biggest cost, is that lack of putting money in the first year. Their contribution is just not going to be a lot of money. And so I would say that, if a company wants a 401k, they should do it as soon as possible, because each month, even when we do a 401k, if we did one now in June, they wouldn't be able to start to put it in until August. So that, therefore, they're going to get less bang for their buck because it goes in monthly. That would be my assessment on the waiting problem.
Okay, thank you.
Any more questions for Chris? Sure, go ahead.
Sure. What is the most common match that is seen by companies with either 401k or simple?
The most common match?
Yes.
Yeah, for the 401k, it's usually a 4% match, and for the simple plan is usually a 3% match. There are some exceptions, but that's what we recommend to all our clients, and that's what 90% of companies do.
Okay.
Why would a company get a simple rather than a 401k plan? You talked about it a little bit, but if you can just summarize it.
Simple versus 401k. Simple for people, as kind of Ben was saying, a lot of times it's a stepping stone to a 401k. When they're just getting started with the retirement plans, people go with the simple. It's very, very easy to set up. There's only one piece of paper you need to sign, nothing to file with IRS, and there's no cost at all, opposed to the small cost of a 401k. So again, just a little easier to set up. And if you don't need to save $18,000 or $24,000 a year, the simple plan limits of, I believe, $12,500 and $15,500 are good enough for them.
Okay.
Right. One of the biggest things we see is the cost. When the SEP is free, so if they have no pension plan at all, there's no administrative cost. On the 401k, we see mostly when you have an owner that's above 50, and when you have an owner above 50, especially if he doesn't have much retirement savings, he's going to want to catch up, so he can catch up with $24,000 plus the match, and so then the 401k is worthwhile because they're putting in more than, or if you have multiple employees, putting more in than the 4% match. We tell people on the costs a lot of times, if somebody has salaries of say $300,000, if everybody participates, 4% of that is $1,000 a month, plus administrative cost of $1,500. So it's going to be roughly $1,200 a month, which in many cases the business can afford it. Sometimes the other employees won't participate, especially if they're under 40, and so they end up paying $600 a month, and then it's very much a reasonable cost plan.
Paul, when you say 50, do you mean 50 years old or 50 employees?
Yeah.
Okay.
50 years old. If the owner's above 50 years old, he does not have significant retirement savings, then a simple isn't going to give him enough to put in, and he's going to be interested in putting $24,000 plus the match, putting $27,000 in per year, and he's going to save $12,000-13,000 in tax, and then it's going to accrue tax free, and he's going to be able to do that through age 65.
Great. Let's see. The lines are still open if you have any more questions for Chris. Yeah. Go ahead.
If I'm a business owner and I get a simpler 401k, can I stop the simpler 401k at any time, or do I have to continue?
Yeah, you can stop it at any time for both of them.
Mm-hmm.
What's the process like to stop it? Is it a pain, or what if I wanted to transfer from a simple to a 401k, say my business grew?
Right, that we commonly see. Either the money can stay in the simple plan, or we can roll all the money into the 401k, and we'd handle that if you would do the 401k with us. There'd be no pain to the employer to do that.
But the simple would have to stop at the end of 1 year, and the 401k would have to begin in the next year, correct, Chris?
Yes.
Okay.
And then on a 401k, if you want to stop it, it would seem there's some type of notice through the end of the year. I think a simple's easier. You can just stop. But I'm thinking a 401k, there's a notice you have to give employees.
Yeah, that sounds right. But I know it can be stopped if you don't want to do it in the long haul. It's the way to stop it.
Yeah, I think it's possible. I don't know the answer to the question, but it is possible you have to go through the end of the year and then stop and notify your employees.
Right.
Okay, any more questions for Chris on 401ks? I don't see any on the internet. Okay, Chris, thanks. Raj, I think you're up next.
Thanks, Jeff. This is Raj Goenka. I'm a CPA with Sullivan Company. I'll talk a little bit about SEP, or Simplified Pension Plans, as the full form stands for. Unlike simple or 401k plans, the major difference here in a SEP plan is that all contributions are made by the employer. Unlike in a 401k where the employee could defer up to $18,000 or $24,000 from his or her paycheck and go toward their pension plan, the SEP is fully funded by the employer. And the method of calculation is easy. The employer contributes a percentage between 0 and 25 of the amount on the W-2s, in case if it's a corporation, of each eligible employee, or the amount of Schedule C net profit in case if it's an unincorporated business, and that's the amount that goes towards the retirement plan of the business owner plus any eligible employees. Out of all the retirement plans we see, SEP is the most uncommon plan among small businesses. The reason for this is because there are more disadvantages than advantages for having a SEP. Where do we see SEP plans? We mostly see SEP retirement plans if there is only one owner, sole proprietor business, or just one owner corporation. That way they can pretty much control how much money will go towards the retirement plans. So for example, if there is just one employee and the owner, and the employee makes $40,000, and the employer, who's the owner, makes $60,000, so the employer can choose to do 10% to go towards the retirement plan. In that case, $6,000 would go towards his retirement plan, and $4,000 would go towards the employee's retirement plan. So that's how the calculation works. It's pretty simple. The significant advantages of having a SEP plan is basically it's very simple to set up. It has no administrative cost like a 401k, and it can be set up even after the end of the year. For 401ks and simple plans, they have to be set up before the end of the year, but SEP plans can be set up even after the end of the year. like 2014, if anyone is interested, they can still do a SEP plan and make a contribution and reduce their taxable income for 2014 if their tax returns are an extension. And another advantage is, just like a simple plan, is there is no filing requirement of any kind of government forms to the IRS or any other agencies. That's pretty much of advantages. And for disadvantages, the major disadvantages is if you have more than one employee and if you want to make a contribution and if all your employees are eligible, you have to pretty much do a contribution for everybody. You cannot pick and choose. And if the owner wants to make a bigger contribution towards their SEP, they can do it, provided they have a bigger amount on their W-2, or if they have a higher profit on their Schedule C business. And in both cases, what they end up doing is they have to pay higher payroll taxes, because the higher the W-2, the higher the payroll taxes are. And the same thing for Schedule C business. If higher the profit, the higher the payroll taxes that you would pay on your tax return. And the biggest disadvantages, I would say, would be they don't contribute every month. They wait until the end of the year to see how much their profit is, how much their W-2s are, and that way they're not making a monthly contribution, and they're losing an opportunity to have made a monthly smaller amount contribution than doing it a bigger amount at the end of the year. So that's pretty much about SEP plans. And I'll also cover a little bit about individual retirement arrangement. Most of us know what an IRA is. Like the name says, individual retirement arrangement. It is not a company plan, but it's set up on your own. These days, most investment companies and most banks offer that you can open up an IRA, and most people do it online, and they just set up a monthly deduction from their checking account. That way, the money, which can be up to like $300, $400, $500 a month, goes into their IRA, and it pretty much accrues tax-free in the account as soon as you invest it. There are no tax forms that needs to be filed. It's pretty simple to open up an IRA, and the contributions can be made anywhere between January 1st of current year until April 15 of next year. Some people wait until the end of the year when they file their tax returns. They make the contributions, but we tell everybody that you should make the contribution each month. Paul mentioned it in the beginning that if you do $300 or $400 a month, everybody can do that, and if you wait until the end of the year, you have to write a check for $5,000 or $5,500. And the limits for contributing to IRA are not as high as simple 401k. The limits for 2015 is $5,500 if you're under the age of 50, and $6,500 if you're above the age of 50. And even if you have another retirement plan through your employer, if your employer already has a 401k or a simple or a SEP, we recommend that you also contribute towards an IRA each year. Because if you have earned income, you're allowed to contribute to an IRA. And even if it's a little amount, it grows tax-free. And even $300 per month can become up to $300,000 in 30 years. So that's the big advantage. Then you don't have to depend on Social Security only. The advantages of having an IRA is it's simple to start. There is no administrative cost, no tax forms to file, and can be set up after the end of the year. The disadvantages to speak of would be the contributions are limited, $5,500 or $6,500, and sometimes you don't get a tax benefit when you contribute, but still your money goes tax-free into the plan. So that would cover the SEP plans and the IRAs. If anyone has any questions, they're welcome to start now.
I have a comment on SEPs. Most SEPs we see have been converted to 401ks and simples, and the reason is because the SEP, the company, it comes out of the company's funds, and it's allocated to the employees based on salary. some employees are not interested. They're not. They could be in their 20s and 30s, having other goals. So they're forced to allocate an amount to the employees when the employees don't really even act like it's a benefit because they're not interested in a retirement plan. In a 401k or it's simple, there's a match. So the way the employees say that it's important to them is they withhold 3% or 4% in the 401k. So when they withhold 3 or 4%, then the company pays 3 or 4%, and they're telling the company that retirement is important, and that's why most SEPs have been converted to 401ks or simples.
Thanks, Paul. The lines are open, so if you have a question on SEPs or IRAs for Raj, just go ahead and speak up, and I'll check on the Internet while we're listening.
Yes, if I'm a small business owner filing on Schedule C, can I have a SEP IRA and also contribute to a simple?
Yes, you can. There are limits which you cannot exceed, but as far as you can have 2 plans, you're allowed to do so.
It would have to be separate businesses, correct?
Yes, it has to be 2 separate businesses. So assuming you have 2 businesses, you file 2 separate Schedule Cs. You can have a simple plan through one business, and you can have a SEP plan through another.
Is there a limit on the contribution?
The contributions for all the plans are limited to $53,000 for 2015.
And that's $53,000, adding everything up: profit sharing, traditional IRA, simple SEP. Everything can't, be more than $53,000. But I guess to your question, I think a good idea maybe with a SEP, if there is one, is if you work for somebody and you have something very small on the side and you're making $10,000 or $20,000 in self-employed income, it's a very good way to get your self-employed income down, without doing a lot of paperwork and stuff like that. But again, as our main retirement plan, we don't really recommend SEPs.
Okay, thank you.
Any other questions for Raj on SEPs or IRAs? Okay. Paul, do we want to go ahead and just open it up to any question on any
anybody has
topics?
any questions on, the floor is yours. Now's the time to get your money's worth.
Okay. The lines are open. Again, just speak up if you have a question. Paul, I'm checking on the Internet. I don't see any coming through there.
I have a question that we've talked about before with Paul is, if I work for some place and I have a bunch of 401k plans, I work 3 or 4 places, what's the best thing to do with that? Do you recommend letting them sit, or should I, move the money, take it out of the 401ks? What should I do?
Paul?
If you're talking about if you leave a company?
Yeah, if I leave 3 or 4 jobs and I have all these 401ks sitting around,
right,
what's
if you leave
the best?
The problem is the management of the 401k in the old company. You have no control over it in many cases. So we have people roll it into an IRA, and then the IRA is managed. And it is better to have, all in one account versus, 3 or 4 other accounts. It's very hard to keep track of and harder to manage. So we recommend they roll it over if they leave the company.
Right. Okay, thanks.
Other questions? Lines are open. Go ahead and speak up.
Can I contribute to a simple IRA in my company and also have a deductible or non-deductible IRA for my personal return?
That's a good question. Paul,
yes, you
Ben,
can
Chris?
have both. The deductibility depends on how much income you make, but anyone with earned income can have an IRA. So, yeah, if you're contributing to a simple or 401k, you can always have an additional traditional IRA.
The problem we see in the Washington area is that, this is a high-cost area, so people's salaries are higher. So we tend not to have people that qualify for a deductible IRA if they already are in a company and have a 401k. It can happen, but we don't see it. If they would, normally we would want somebody to contribute the maximum to their 401k before they did an IRA. So, if they're under 50, they contribute $18,000. Then you would want to do it all in the 401k before you got to your IRA. if you still had if you had enough income where you could contribute to the 401k, $18,000 plus get the match, then probably you wouldn't be able to. Your income would have to be high enough that you'd be above the point where you'd have a deductible IRA. The smart people over the years, I will tell you, the smart people that we've done work for, they contribute to a non-deductible IRA in January of each year. So for 2015, they've already done it. And we have people in their, it's hard for people to do that in their 20s and 30s. They're trying to buy a house. They have other expenses. They could have children. But, once they get in their 40s or 50s, we have people, they're trying to catch up on their retirement. They maximize their 401k, and then they also contribute to a non-deductible IRA of $6,500 every year in the first month. And they do it consistently, and it does add up. Even though it's not deductible, it does accrue tax-free, and they invest it, and it's a very good habit to get into.
Paul, I do have a question came through the internet. Martin asks, if I have a 401k from an employer as well as an IRA, is there any other recommendations? Does that make sense?
He's saying that he maximizes his 401k contribution and he maximizes his IRA contribution. And I'm going to let anybody else answer that if they can. What would you recommend to somebody like that who, or they could do something additional?
Right. If you have extra money to invest, you can always invest in a traditional brokerage account. The only difference is you would be taxed as the money earns income from interest or dividends or capital gains, which in an IRA situation, you're not taxed on any of that. But if you want to contribute more than your maximum 401k plus your maximum IRA, you can always invest as much as you want in a nice managed, structured, traditional brokerage account. That's the only suggestion I have.
We also see besides putting in the maximum for the IRA, we see putting in the maximum for the spouse. So that's if they're over 50 years of age, then they put in $6,500 of that. Now, if they have their own business or they have some control over their situation, and their spouse works in their business, we've seen, of course, the spouse has to work in the business to do that. But if the spouse works in the business, then we see people, for example, they have a W-2 for $30,000 and they withhold $24,000 maximum contribution on 401k, and they have the match, and the spouse does work in the business, and that doubles the 401k contribution if that person has their own business. Now, if they don't have their own business, or if the spouse does not work in the business, we don't recommend that. But sometimes we see that they do, and at least you could get the spousal IRA for $6,500.
Great. I hope that answers Martin's question. Any other questions on the internet?
The only other thing we see in addition to that is we see a systematic investment in a taxable account of an amount each month, automatic debit, budgeted amount based on affordability, not voluntary because the people end up not doing it, but it forces them to put. For example, we have clients that put automatically $4,000 per month into a taxable account. That is additional savings in addition to their retirement plans. So, does that answer the question?
I think so. We can't converse over the internet, but
okay.
If Martin has a question, he can always give you.
He can always call or email us.
Right. Mm-hmm. Okay, phone lines are still open. If you do have a question on pension, simple SEP, 401k, IRA, go ahead and ask it.
Sure, I have a question. What investment options do Sullivan Company and Archer offer in the management of funds for a 401k or a simple IRA?
Chris?
What, you said management options, you said?
Investment options.
Yeah, what we have recommended for a retirement plan is managed investments, which is portfolio-style investing, to use a big word. Essentially, we have a advisor named, a manager named John, who manages all the money for you. Basically, what we would do is we do a brief interview and talk to you a little bit, and then we kind of get an idea of how risky you'd like to be and how conservative you'd like to be. It depends how old you are, what other investments you have, your attitude towards risk, and a couple other factors. And then essentially we would just put you in a category, either aggressive, moderate, conservative, moderate, or conservative. And then we let John manage the money. We trust John. He's a guy who manages money all day long and has time to study stocks and bonds and money markets and the market as a whole, the international market. And the money would be managed in one of these 5 portfolios or just groups of risk. And that's how we suggest doing retirement investing. There's other types of investing that we recommend for other situations. If you have money in addition to this that you'd like to invest, there's other ways to invest. But for retirement plan, as we've been talking about, the qualified plans with managed portfolios, we've recommended to people because we've seen how when people make their own decisions, a lot of times these decisions are made off of emotion or off of something you hear on TV and sounds really good. But in general, when a professional does it, it's just much better because, again, this retirement plan really should be a large portion of your retirement money, the money you're going to live off of for 20, 30, 40 years. And, we suggest letting a professional manage it. That's pretty much the investment options we would recommend. If you're in a 401k, you can also manage it yourself. There's always that option. But we typically would recommend you just invest in one of our portfolios that is professionally managed.
Okay.
We have another question through the Internet. It is common sense is telling me that I should probably use a Roth IRA while I'm young and switch to a standard IRA once I'm approaching my retirement age. Would that be your recommendation as well?
The Roth IRA, you don't deduct. It accrues tax-free. When you take it out, there's no tax on the withdrawals. Would be a good strategy when you're young, without a doubt. It's you don't have a tax savings, your tax bracket could be lower. You can do now Roth through 401ks, same principle. So I would think that that's regarding a Roth is a good way to go. Does anybody else have any comment on that part of his question?
I would agree. I mean, it's one of the only times in the tax code where you're not going to pay tax on something. You pay tax now, but say the money grows from $5,000 to $20,000, you pay tax on the 5, you don't pay tax on the 20 when you take it out. Yeah, so when you're young, 20 is into the 30s, you're probably going to get a lot of growth, and then at some point, yeah, you should switch over to a traditional.
Yeah, when you're 60,
plan. When
you're 60, there's not enough time for growth. Although you could still have the same principle depending on tax brackets.
Yeah.
You could, depending on tax brackets, you could have a deductible 401k. It's not going to be in as long. Most people use their taxable accounts first, and then use their non-taxable accounts in retirement. The Roth is going to be in there for a while. The IRA, I guess you would take next the deductible IRA, and it wouldn't have as much appreciation, so it wouldn't have as much effect. I would think that's a good strategy, yes.
Yeah, the only drawback to the Roth is anyone can contribute to a traditional IRA, which would be, as Paul's saying, non-deductible IRA, but if you make, I believe, over 116 if you're single, or 180, 190,000 if you're married, you cannot contribute to a Roth IRA or its limited contribution. So that's pretty much the only drawback for a young person doing a Roth.
Right, and this being a higher income area, we see many people over the Roth limit. Most of the people under the Roth limit want a deduction. Nevertheless, it still is a good idea. The Roth, early in life is a thing to do.
Thanks, Paul. Thanks, guys. Lines, again, are still open. If you have a question, just go ahead and speak up.
Do you have any recommendation on how much should I contribute per year to my retirement plan? What would be the percentage from my income that I should be contributing yearly?
we would suggest you do at least 10%. That's the rule of the thumb. But it really depends on your budget, what your other expenses are, how much money you're saving. But if you can, you should do at least 10%.
And if you can, any amount is a good amount. It's just a matter of getting it monthly. You know, if it's $1, if it's $10, if it's $1,000, something's better than nothing. But again, 10 is a good number, as Raj said.
Okay, thank you.
Paul, I don't see any other questions on the internet.
That's good. We've had enough questions.
Okay. Well, want to thank everybody for being on the call. And Paul, just as kind of a wrap-up to add to what you've talked about, if somebody's listening to this on the replay, if they have a question about their situation, whether they're an employee or a business owner, what's the first step or the best way to get a hold of you to maybe start a conversation?
The best thing to call Chris. We have two offers we make to businesses and individuals. For businesses, we offer 401k review. Typically, for companies, many of them get 401ks for their employees, and the costs involved are far from what they think. The costs that you see for administering a 401k sometimes are, they are, I believe the information's entered on the Form 5500, and we'll have an owner that thinks he's paying $2,500, but in reality, the 401k administrator or investment person actually will sell commission funds, and those commission funds have either front load or they have a higher cost, and those are sold to the employees, and many employees don't know enough to know. And although the owner thinks it's $2,500, they're actually paying $10,000, and they really don't know it. In general, our model is the people pay a management fee, in which they get a service. The service is a asset management amount, which is not paid by the mutual fund. It's paid by the client, which the client sees. The other model where you have ABC funds, the commissions are paid by the mutual funds, and the people don't even see it, and it comes out of the expenses of the fund. The second offer we give is for individuals. We offer second opinion for review of investments. There's no obligation, especially if they're an accounting client, accounting or tax client. We want to give them that information. They don't have any obligation to change to us. We're basically just giving them education. If they decide to, that's fine. But I think it does. We do it commonly for our clients, and if they stay with the same advisor, that works. But they do get some information that helps them. So we offer all that to all of our individual clients.
Super. Paul, if they want to call, what's the best phone number? And I guess from an email standpoint, what's the best email address also?
Best 301-657-8080. Chris is extension 142. I'm an extension 102. But I would go to Chris first. The email is cbailey@esullivan.net.
Great. Well, again, we want to thank everybody for being on the call today with Paul Sullivan and Sullivan Company and all of his staff and experts. Our call today was titled, What Kind of Pension Plan Should You Have as a Business, as an Employee, or a Retiree? And again, if you have a question and you're listening to the replay, give Paul and his staff a call at 301-657-8080. Paul, thanks for taking the time to do this. We appreciate it, and we hope to talk to everybody soon.
Thanks, Jeff.
Thanks, Jeff.
Thank you.
Thanks, guys.
Thanks.
Bye.